You can invest with us, and you have monthly distributions. You're secured, and you're making 12 to 15% a year.
Hey everyone, Traded Black back here in Las Vegas for MJBizCon this week. We're bringing in Rob Sechrist, president and co-manager of the Pelorus Equity Group. Good to see you again. How are things?
Going well. Been busy.
I bet. How's the week been?
Well, hanging in there.
Yeah.
I've been able to make it back to my room each night before midnight, and none of our crew has ended up in a bad spot yet. So.
Yeah. Well, that's good. Busy week to say the least. I know legislation has been top of mind right now amongst many executives within the cannabis industry on the equity side. But I want to talk about you as we've been continuing to have conversations with you in a lot of podcasts in the past. First off, the project that we did out in Desperate Hot Springs, that was incredible. A lot of the feedback that we're getting, we got calls from the city councilmen talking about how great it was just to be featured and just the growth opportunities as to where it all started. So let's learn more about the fund itself. And the fund basically allows investors to invest in a pool of real estate assets of U.S. cannabis operators, which then they make income basically off interest from those assets.
Correct.
So when we look right now at the market, the public side, it's very risky right now. Private side that you guys continue to push down the advantages that it presents right now, both short-term and long-term. So as my viewers learn more about the fund itself, what advantages are you finding right now in conversations you're having this week on what your model on the private side presents versus, say, competitors in your space that are on the public?
Yeah. So I always first try to start off by saying, if you're in the public side, you've got the share volatility.
Yep.
And that may or may not be reflective of what's actually happening with the stock price. So this is true for not only the direct cannabis equity investments in the operators, but some of our publicly traded peers. And so by us remaining private, we've de-risked that. There is no volatility of our share price. So that's a massive strategic advantage for us. We didn't think that it would come to fruition for our strategy to play out in our benefit this quickly, where our peers are trading at or below their book value. So
right.
That we're continuing able to raise capital. We're an open-ended $1 billion fund market cap for the sizing of the fund. We're at $370 million today. But in our structure, there's to our competitors that are in the same sector as a private mortgage REIT, we all make REIT dividends, and there's a tax advantage of having that REIT dividend. You save 20% reduction in your federal tax rate.
20.
And you only get taxed in the state that you're domiciled in. So for no tax states like Nevada, where we're at here today, or Texas, Florida, that's a huge advantage to those investors. And the third one, which is less significant, is that there's the REIT structure cleanses the possibility of something called UBTI, and so that's really important for tax deferred accounts. And it's really difficult to find a ultra high yield investment like us that makes monthly distributions with the type of liquidity that we have that eliminates that UBTI. So we have a lot of ERISA money, self-directed IRA money in our fund as well.
What would you say? New investors that want to get involved in your fund, one or two common questions that you hear that they're starting to learn or understand more, because a lot of people involved in this industry, as I said, focus on the public equity side, and they're actually quite surprised when they hear your model in play. But if people are new and watching this or garnering some attention or some interest towards this, what are common questions that they, I guess, ask a lot of the times that you hear?
We get hundreds of different types of questions. I think that one of the top questions we get from a lot of investors is, how do we value the real estate?
Right.
And that's a really important factor. And so the way that we value it is on a cost basis, replacement cost. And we feel that that's the most true metric to be able to evaluate a cannabis use property. So every dollar that they put into that property, we will give them credit for that dollar being spent. The reason that we don't utilize the loan to value or the income approach or the comp approach is because there's not been any true secondary trades, arm length secondary trades, to establish what that property would trade at an arm's length. I accidentally said income approach, but I meant the sales comp approach. So that's what you usually have three methodologies. You have replacement cost, income approach, and you have comparables. And
Okay.
so comparables is the methodology that doesn't exist for cannabis. There's just no secondary trades that are arm's length of a fully stabilized property to be able to know what those LTVs are. So when you look at the cost basis, which is much more conservative, we're lending up to an average of 60% loan to cost basis on our bridge lending product and up to 75% loan to cost on our fully stabilized lending product.
So how do you determine what you're investing in when you're trying to limit risk on where to invest in, or not, excuse me, invest, but lend? How do you limit risk? Because I know we've talked in the past about your data proprietary tool, and we haven't really touched on how exactly it works, because this is across all markets across the U.S. But if you're lending money into certain markets, what are some of the first approaches that you take?
Well, the very first thing we require is it's got to be an experienced operator. So we're trying to de-risk every single element we possibly can. And so the first one is their experience. We can see that they have a proven track record. The second is we have to have a hard asset, real estate.
Right.
And so even if that borrower or that cannabis operator tenant was to fail, we have the hard asset. And they already put down 40% protective cover equity cash coverage there. So we can reposition that asset. We would, put in another tenant, and then we could get that income going through on that tenant again. And so that model, we've de-risked it because we've got the ability to replace that tenant if we needed to, and we've got the hard asset. So those two elements are required, but we have one other significant element is we have personal and corporate guarantees on all of our transactions. And so we require sponsors that can handle the sizing of transactions, whether it's individual guarantees or groups of guarantees, or it's a corporation, a publicly traded company that can manage that.
So we're looking at lending towards dispensaries, cultivation facilities. Is there anything?
We're agnostic to any type of licensed cannabis-related business. We have the least dispensaries in our portfolio just because dispensaries require it's the easiest type of loan to do. They're generally smaller balance loans. They're generally in urban environments, and the banks are willing to take those deals. So we've only got a few, and it's just part of a broader collateral package for us.
I know we've talked in the past with Travis just about, you guys used to lend money in the pharmaceutical industry, and it was something that is an industry that was already established, right? And with cannabis, you really had to understand what it was because no one really understood the business side of it all. So when you compare yourself to, say, traditional banks, I think it's important to really define what you mean by that, because in the event that whether we see legislation moving or not, it's just like when you see your growth trajectory that you're outlining, like you were $5-10 million of lending assets under your umbrella as little as 3.5 years ago. That's grown to almost $400 million to where we are today, and you project to go to over $1 billion in the next 12 months.
Yeah.
Why are you able to do that based on what I'm kind of outlining?
So going back to your initial premise of the question, when we have originated prior to being in the cannabis sector $5 billion, 5,000 loans. Those loans were made to either single-family residences, hotels, other types of income properties, pharmacies. And what the example that we were talking to about the other day with Travis, and what the point is that when we're lending to a piece of real estate that has a pharmacy as the tenant, or CVS or whatever it might be, we didn't need to be an expert in being a pharmacist. We didn't need to be an expert in being a hotelier. We didn't need to know that stuff because it was a fully mature market, and everybody knew the comps and the numbers and the regulations and all of that. In cannabis, because it's a new emerging industry and it's totally new for each state and it's different in each state, we ultimately had to become experts in cannabis related real estate and the build outs, and be experts in the cannabis operating business. And to do that, the way we work is we use data points and we use facts. And there was no facts. And so we did have 2,000 transactions that we had aggregated information, but it becomes stale and it's regional. And so we needed to develop a methodology to have the ability to see every single license in the entire country, who owned that license, what type of licenses they held, where that property or that license was physically located, who owns that real estate, is there a lender there, is there any secondary trades on that real estate, what's the energy cost there, what's the cost to build there, what's the price per pound there. And so we layered in all that information to be able to put it into a dashboard where we could look at the region for that particular transaction. We could also look at it on a map and see who's the competition that's in the area. What is the tax zones in the area? Is there an adjacent city that's going through a referendum to have cannabis approved? That's a lower tax, excise tax. So all of these things we have to take into account. Or has there been total capacity built for the state where it's not necessary to build anymore? And so these are all things that how we think about de-risking transactions is bringing in those data points. And that's how we know.
So you learned as you go, right, with a lot of this stuff?
We did. In the beginning, we knew that there was no possible way that we could have a saturated market for building cultivation because nobody had done it yet. But we knew that at some point we will reach saturation, so we needed to track that.
Wow. Do you see banks getting involved eventually?
Oh yeah, I just left the meeting with a big bank. And
what was their take on it all?
The bank we were just talking with was Safe Harbor. They just recently de-SPAC'd, and they're going to be one of the big national banks in the sector. They come from the sector. There's many banks here. There's 704 banks on FinCEN's website. So about 15% of all the banks in the entire country are cannabis friendly. To some degree, you have tier 1, which is plant touching or cash. And then you have tier 2/3, which is what we are, which is ancillary. So that 700 and plus number is all tiers of types of banking. And it would be primarily more the tier 2/3 ancillary. But of all those banks, there's at least 4 dozen that we're tracking that are doing direct lending today, including Safe Harbor and including our current bank, First Federal Bank of Florida. So they are originating. It's just a bank can only do a credit like Safe Harbor can maybe do up to $5 million. And we don't even really look at loans until they get to $5 million. So there's just a different fit for different types of transactions. You're not going to go to a bank for a construction loan. That's our primary lending product that we do. And once it's fully built, then traditionally you would refinance that into a bank loan. But today, you may or may not be able to get the sizing that you need to go to a bank refinance. And I don't see that changing with legislation. So we believe that
you don't.
Yeah, the reason is that this asset class is a specialty use asset class. And that's not going to change with legislation.
What does that mean when you say that?
So specialty use asset class is where the highest and best use is a very specialized. And in this particular circumstance, not only is it built out with specific tenant improvements and lighting and heating and water and power and sealed doors and ventilation systems, but it's also licensing. And so it's the most similar categories would be data center, cold storage, or lab space. But this is even more nuanced than that because of the licensing that's required for both the property. In some cases, like California, has to be licensed as well as all of them have to have licensed operators for the tenants.
Very formative, right? I have to ask, one can think that when you first started, smaller transactions, which are now getting bigger, we've touched on this in previous podcasts about the announcement you made back late September, I think it was, about the debt financing deal with Terracent at $45 million. You're meeting with some of the biggest, I would think, players in the space. So one can only wonder as to what the growth trajectory is going to be as we look at the pace as to currently what you're on. But let's bring it back to people that actually are thinking and considering investing within your actual fund. Walk them through as you grow and you're working with these U.S. cannabis operators and they're making interest or income based off the interest through these U.S. Cannabis operators. How exactly does that unfold and work?
So we're just a secured debt play. Our target yield is 12 to 15% net IRR annually. We make monthly distributions. And so for us, you can think about it this way. You can either go into the direct equities market, make a guess on a company to invest in and hope that there's a turnaround on that company. But in reality, maybe it works, maybe it doesn't. Or you can invest with us and you have monthly distributions, you're secured, and you're making 12 to 15% a year.
So monthly distributions they're receiving with 12 to 15% returns
Annualized.
annually.
Yeah. And so what that means, if you were to extrapolate out at 15% return, we're in our 4.5 year. So our first investors have had either all of it or almost all of their principal returned in distributions now. And so you could have taken the path and gone in direct equities, and you have a substantial risk there. No distributions. Maybe you hit a 10x, but maybe not.
Mm-hmm.
With us, you're going to get 12, 15%. And in addition to that, we do have equity upsides, and you didn't have to pay for it. So as a condition on many of our loans, I think 6 today, we have equity upsides or equity kickers, and most of the transactions that we're originating for the rest of this quarter in 2023 have that. And some of these companies are companies that you would never, ever be able to participate as an outside party. One of the transactions that we're looking forward to announcing next year, and we've already closed some of the pieces of it, is a brand that everybody would want to be in, and it is. There's no access to get to it, and so you could only get to it through us.
Wow, and that's next year.
Yeah, it's already been happening, but we won't be able to announce it until sometime next year.
I've heard you say a couple times that you're lenders, not partners. Care to elaborate on that?
Yeah. So everybody throws around the word partner, and why we try to distinguish that you want to talk about that you're a partner, but in a partnership means it's a two-way street. And so as a lender, we don't get the upside. So we're not
Good point.
So I try to remind, when we've had borrowers prior to cannabis, and they said, "Look, no, we're partners. What do you mean? We're like, well, wait a second. You weren't willing to share. We never asked you for upside, and if we had it, you wouldn't have given it to us. But yet, if there was some downside, you want us to take a hit with you, and that's not how that works.
Right.
Where we can partner is where we can listen to what the situations that they have, and we can propose solutions. Now,
has that happened a lot?
It happens all the time in construction. Once you start a project, from where you started it with the information you had the day one to where it is in the timeline to getting it completing, things change and are dynamic all the time. And we're really good at solving those solutions or coming up with paths that can get us there. That's fairly uncomplicated, but sometimes borrowers get themselves into situations where they may or maybe have never had that happen before. With us doing 5,000 transactions, not only do we know how to solve it, but we know who to go to get it solved, and we can give them a really clear path on how to solve that. That I wouldn't call that a partnership, but I would just call it a strategic alliance.
Makes sense. $45 million, you said 6 weeks ago with Terrascend. What exactly will that money go towards with their operations?
Yeah, so for them, I believe that their intention with that transaction was to free up some equity and for them to be positioned to take advantage of some of the dislocation in the market for 2023. So they're just basically kind of breaking free some cash to be able to do some expansion and acquisitions if they want. What we were really proud to hear is that we had the closing dinner with them, and they were alluding to some really incredible efficiencies of scale and cost savings, and we hear this all the time. But then the report came out, and I might have this wrong, but I believe I have it right, that they increased their EBITDA by 800% in efficiency. So that's an enormous gain, and I think that's one of the there are companies, big MSOs, publicly traded, and small ones that are doing well. Our portfolio is strong and performing, and I think that you only hear from the people that are troubled. You hear about the California market being a disaster. That's the outdoor wholesale market. But even California, the market intelligence from out here at the conference on the floor and from our borrowers that even the California market's already turned around. So you had people that went through periods
of that.
Yeah, directly. Yeah. So, there's three basic types of product in cannabis. There's the outdoor wholesale product that is what generally is talked about, and that was down to as low as $100 a pound. It typically costs $150 to $450 depending on where you're at on that product. Then you have indoor greenhouse or light dev transaction or a type of product, and that product is now somewhat more of a controlled environment, better quality, more controlled, sustainable. That product now is selling for $350 to $450, and so they're back to where they can start breaking even or making some money. But in the transactions that we do are owner users selling to themselves, selling direct. And so even if the wholesale at the indoor level, which was at around $900 to $1,100 in California, that's already bumping back up to $1,200, $1,300, $1,400. So that price is going to come back. And so it's just a natural progression. You're going to have years where there's an oversupply, and then you're going to have a glut the next year of undersupply, and it's going to work itself out. The difficulty is, do the operators have enough cash to make it through when they have a down year? Mm-hmm. The gentleman that I was speaking with yesterday, they burned through almost $3 million in 3 months to sustain their operations.
Why? How?
They were taking losses.
Wow.
But I said to them,
where was that located?
California, and it's not our borrower, but it's somebody that we know very well. Very good operators, and so they were the ones telling me they were down to $100 a pound, and now they're back up to selling what their product should normally be at $350 to $450. They were selling for $550, and so I asked him, I said, how did you know to stay in the game? Because you're burning up your $3 million and luckily you had it. He said, we know every year that it comes back after October. And so we already saw it turn around. And so we knew that if we stayed in the game, we knew that a lot of our peers, local peers, didn't have that capacity of reserves. And so some of those, unfortunately, those other wholesalers are not going to make it through. Mm-hmm. But it's just the evolution of what's going to happen. I feel that the wholesale market was how California was built, was selling to all these brands over all this time.
Yep.
But as the brands developed and became more, made larger investments in their brand name, they couldn't afford to have the lack of consistency and quality or the lack of product in being delivered year round. And so they started making investments in their own facilities. And so that wholesale market was diminishing, if nothing else changed, just because the brands were starting to cultivate for themselves. So that market was already was shrinking, and plus you had more and more people coming into it. So, and in California, for us to de-risk transactions, we believe very strongly that you should have your own brand or be able to show in your model how you're going to sustain these market cycles of if you're doing wholesale.
Do we have any idea how many brands there are in the state of California?
I
don't even want to think about it.
So there's I think we have the total of the licenses. I don't remember if it was 9,000. I think maybe 9,000, but wow. Licenses, total licenses, and I think only 6,500 were active. If these are, I could be totally wrong, but I'm just shooting off the top of my head.
Well, I think the big takeaway that people are just listening to you is how well educated you are. Like you understand this, and you and your team inside and out. And again, I think we need to kind of like reiterate: 12 to 15% annual returns. You're managing close to $400 million in assets. You want to get over to $1 billion within the next 12 months, which is going to see big growth opportunities. And not to mention saving 20% in certain states based on your federal tax income. Yeah. How do people know or want to learn more about, finding out information regarding to get involved in the fund? Like, what are you looking for on your end?
So if you're interested in learning more, you just shoot us an email, and it's IR for Investor Relations at Pelorus Equity Group. And Pelorus is PELORUS, and the word equity and group.com. Send us an email. Just let us know you're interested. What really helps us is to know where you came from. We get inquiries all the time.
What happens if you're Canadian or even European?
Great question. So we can board any investor or entity as long as it has a U.S. tax ID.
Okay.
So we do have Canadian investors. They had U.S. Tax IDs,
right,
or entities. We can do that as well.
That's great.
Yeah. So yeah, we have people. Our fund is mainly structured of more than 1,000 investors. The vast majority of them are retail investors. I think our average check size is about $258,000.
I'd be curious to hear some of the conversations that you have with your investors involved in your fund that used to be on the equity side. Not to sit here and say that they're not anymore, but what do you think they've learned most?
Well, I think that that bucket of investors is not where I don't think that our investors came from there.
Okay.
I think that most of our investors, the biggest spike that we saw in investment come in was during COVID in 2020. And those investors, what happened was so many people went to maximum liquidity because they weren't sure what was happening in the economy. And once people figured out, okay, COVID is bad, but it's not, I don't feel it's going to affect me that much, or I'm feeling comfortable, or I can start putting this cash back to work. When those people started thinking about how they wanted their money to be back to work, they realized that real estate sector with COVID was impacted across the board. The entire universe of all sectors of cannabis was affected, except cannabis, and it was deemed an essential business. And so I think when people started thinking about it, they said, first of all, I don't like this volatility. I had to sell all my stuff at a discount because I needed liquidity. And now, I'm already bummed out about that. And now I want to get it working. I don't want to be in that same situation again. I just want monthly return. I'm not looking for a 10X. I'm just looking for income. And so we went from, I think, 6.5 million assets under management to 54 million
during that time.
And it's totally counterintuitive that happened. But we were bringing in, 10, 20 million a month in some of those months. And so those investors, I think, were not equity investors per se. They were just households trying to figure out where do I put some money out and I feel comfortable that I've already got too much exposure in non-cannabis real estate. Almost everybody has some investment in their portfolio, even if it's in equities that is, might be Blackstone or Apollo or whatever it might be. And they realize, look, I'm too heavily concentrated in non-cannabis, so I want to take a sliver of cannabis to offset that risk of the real estate portfolio. And these guys are kicking out 3 times the return that those guys are. So, plus they have the tax advantage of the REIT. So, I think that was kind of the start of it. I think today we're trying to target more equity investors and make them realize, look, in this particular sector, you can't possibly be an expert enough as a retail investor to know who to bet on. And so
certain things you don't know.
There's not enough velocity. There's not enough maturity in the market. There's so many unknowns that even if you did have a good performing operator, that may not be what's going to hold true into the next quarter or 2 quarters or whatever it might be. So without having those experts in market intelligence to a fully mature market where all the data points and the regulations are known, you're really taking an outsized risk of what the return upsides might be. I think that we're getting pretty darn close to the bottom, but I thought that was the case in 2020. For example, I bought a bunch of cannabis equities, and I'm not a big cannabis equities guy, but I figured it couldn't really go much slower than in March of 2020. And, I would probably add to some of my positions right now, but I don't really like the stock market because I don't like the volatility, and I don't like. I'm willing to. I'm precluded from what I can invest in, and one of the problems for me is I don't know if I might be lending to them in the future, which I'm probably okay if I already had bought the stock, but I don't do a whole lot.
What's your average check size again?
I think it's about 258,000.
And your money's doubling, you said, after every 4 to 4.5 years?
If you reinvest, if we have a 15% return, it's 4.2 years that you would have 100% of your principal returned. And so we're at that point today. This particular year with a 12% return as opposed to 15, just because we had so much cash drag in the beginning of the year. But within this year, those first investors are now playing with the house's money, which is an awesome place to be, because now you're able.
4 years is not long.
It's not that long when you consider, and it is a long time, but in most
in today's day and age.
when you're long on us equity, you're going to be into it for at least a
Yeah.
year or two, and it might be several more years than that.
Yeah, but they like forward statements, and if you can double your money in that time frame, it's very lucrative, and that's what people like to see, obviously, in this day and age when it comes to investing. Bold statement. What's on the agenda tonight? Rob Sechrist will be out all night in Vegas tonight.
Yeah,
True or false?
No, we've got some, more meetings, more press people, and one of our major borrowers will be speaking with, and so we're just book solid here. It's the amount of intelligence that you can get and glean from the entire industry in one spot at one time is enormous here, and so that's information. If you're going to be in the cannabis equities market, you would want to be at every single. You just want to follow the trail that I'm going on, because you need to know if you're investing in this, you need to be an expert in it. And so we do. Some of our investors come to these conferences. We have one investor that goes to every single one.
Wow.
And he's an older guy and
learns a lot.
And he's like, this is just what I do.
Yeah.
I'm now independently wealthy. I can live off my investments, but part of my job is to continue to be abreast of what's happening.
Do your due diligence.
Yeah.
There was actually a database report just in some of the predictions as to what they're seeing going into 2023. And some of the fascinating stuff, like 9 of the top 10 brands in the U.S. are run by multi-state operators. A lot of the emerging markets are going to be relatively flat this year. They're going to see a lot of the new emerging markets like the Marylands and Missouris that just came out into the market and legalized adult recreational use cannabis, that we're going to see a lot of growth opportunities pertaining to that, and a lot of mergers and acquisitions that'll take place. Again, that's on the public equity side. But as we look at this, I have to ask the question, like, you're meeting probably with, and one can put into context as to who are some of the companies. If you're dealing with the Terrasons, could we see other relationships with other multi-state operators eventually down the road?
Yeah, So we have other multi-state operators that are in the queue, and lots on the go. Lots of good stuff coming up. Yeah.
Appreciate the time.
Yeah.
All right. Thanks, Rob.
All right.
Hey, everyone. Thanks for watching. So what'd you think of the interview? If there's any information that you want to know more of or want to learn about, then provide us with feedback by leaving a comment below. And if you like what we're producing, then feel free to subscribe to our channel, share this video with your network, and as well, click on that bell for all notifications, because we would not be here without you. We appreciate it. Thanks for watching, everyone.